Yeah, sure, ma'am. Aman, can you go ahead and share the screen? Is it visible? Hello.
Yeah, it is visible.
Okay, so first.
Hello, yeah. Aman, should I start? Yeah.
Yeah. Yes, first we can start. Yes.
Yeah. Uh, our term paper is based on venture capitalists and stages of financing in India. Uh, so let me introduce with this paper. So this paper helps us understand the venture capitalists, their advantages, their stages of financing, and how Indian society benefits from them. So, what is venture capital? Venture capitals are the funds that are made available for startups that has extraordinary growth potential. The capital is provided by professionals who invest in aspirant businessmen who have the talents of making rapidly growing companies. So they help in funding and financing new growing businesses, providing equity solutions to them, develop and manage their new products, uh, and gaining value for the business in the market. Then, what are the advantages of VCs in India? Uh, like it generates long-term equity investment and ensures a stable capital structure. Both the risk and the gains are shared by VCs. uh, a venture capitalist can assist the firm with practical counsel and recommendations based on their market experience. A VC also has a broad network of contacts in various fields, and that helps the company to provide the value. Uh, they also show us more rounds of money to support expansion and further help. Now handing over to Shivam for stages of financing.
Thank you, Push. Now we can look at the stages of financing in what stages a company raises the money. The first stage is seed money. This is the pre-commercialization stage. In the layman terms, it is a proof of concept stage when we have an idea and we want to make a prototype or do the market analysis to kind of get a proof that it's working or not. Um, the second round then goes up to the startup stage. It is when the production is initiated and we are looking to acquire the market, have our first customers. We are ramping up the production, research and development, and we need the finances to finance the different cost of acquisition, acquiring machinery, or development of operations, all these kind of expenses. And we need a working capital for smooth conduct of the company in the early stages, because we are not looking forward for the profits in the early stages. That was startup stage. The next stage or the third stage, a startup is subjected to, a firm is subjected to, is the first round of funding. This is commonly known as ramp up stage also, because this is where the VCs actually look into the financials, and um this is a stage where the firms are ramping up the production and looking forward for their break evens. And this is a place where we start finding the ways of profitability in the firm. Then the company moves on to the second round or the second stage of financing. This is where we can find many companies in the current Indian startup ecosystem, like Credit and Swiggy. They are growing fast, they are acquiring a lot of customers, but they are yet to become profitable. Um, so a company in this stage needs financing to manage the uh, operations and to acquire customers, more and more customers, and to expand fast, like Cred and Swiggy, as I gave in the earlier example. Then the companies move into the third round. The third round is when the company is turning profitable, and now we need to horizontally expand it, like Oyo did, expanding it to further nations and stuff like that. The last round we will discuss is the fourth round. Just Yeah, it is also called as bridge financing. It happens when the companies are looking for the going public process. So it kind of fills the time gap between the expenditure and the when the returns are made. The next term I'm going to explain is the methods of venture financing. So now we'll look from the firm's perspective that how they are actually going to raise money from the financiers. So the first and very commonly used technique is the equity financing, where the company sells a percentage of the company to the investors. The uh, sorry, the investors get in the rights of the company and get the profits in return from the dividend, as well as in the future by selling the stakes. The second is conditional loans. So uh, it's like it's slightly different from the conventional loan from the banks. Here, instead of paying the interest, we pay the royalty, which is profit dependent. The next is conventional loans, in which they, unlike the conditional loans where there's no interest, here we are going to pay the interest on the basis of sales and profit. Next, I'll go with the debentures. So there are two kind of debentures: convertible debentures and non-convertible debentures. This is kind of loan kind of stuff from the financiers, where you give your in the convertible debentures, you
You
give
have
your
only a
equity.
minute left.
Okay, I'll just skip this through, and we'll discuss the exit routes. So there are four basic district exit routes: IPOs, the trade sales, promoters,
Uh,
Shivam, I
buyback,
think you
and
can let
acquisition.
Aman go ahead with
Yeah,
the case.
yeah.
Aman, you
but
can go ahead.
because of the interest in time, we can skip the
Aman,
venture.
you're not audible.
Because of the hello, am I audible? Because
Yes.
of the interest in time, we can skip the development of venture capital in India and the venture capital working, as this can be explained very nicely in the term paper also. And we want to focus on the case study. This case study is basically of a Bloom Venture Advisors, a Mumbai-based VC firm founded in 2010, and we will go through like how is it, how a venture firm in particular look into a startup and how they judge whether they are going to fund it or not. So this case, in this case, they are basically focusing in the edtech market because. According to the studies done by Bloom Ventures, edtech is one of
Additional
the
1 minute is being given to you, Max.
yeah, EdTech is one of the growing market in the current scenario. And out of the 25 to 27 investment, roughly 4 to 5 will be in the EdTech sector because of the enormous opportunity and the COVID-proof nature of the sector. If we talk about the market, of the $135 billion that is invested in the education sector, around 750 million EdTech market is captured by the EdTech market in the today's generation as of 2020. So basically, how does Bloom look at EdTech today? So of the 4 and 5 investments which they are going to pitch in the next year, they will categorize them based on their age group served and whether there is a formal sector or they are from a formal sector or an informal sector, and whether and they will check their revenue and its distribution model. So first they classify each of them based on the age group, less than 5 to above 25 years, catering to the age of people, and then they divide them based on the business model, be it formal or informal, and finally based on the revenue model. So once all the divisions are done, they place a matrix in front of them, and they give the market requirement based on the matrix. Like for informal sector in B2B domain for K to 12 schools, 520 millions are required, and they give a particular startup in the same domain. And finally, they identify the opportunities areas based on the future opportunity and the immediate opportunity. So finally concluding, for the next time, if a particular startup want to go on to identify the various parameters that are required to get them funded, so this can be a very ideal framework
Your
for them.
time is up.
Yes, ma'am. They can be a very ideal framework for them, and they can look for this particular kind of stuff. Thank you so much.
Thank you.
Okay. Next, we have group 9, consisting of Harsh Chaudhary. Uh, so, Harsh, please share your screen and present.
Am I audible?
Yes, you are.
Is my screen visible?
Yes, it's visible.
Okay, great. So basically, the term paper I made were consists of Swiggy and a break-even analysis for the company. It's almost it's a very chanceful thing that people before me mentioned Swiggy and its break-even analysis, and I'll expand on that. So Swiggy, for those who don't know, is a food tech company, and basically it earns its profit from it started by delivering food and taking a margin out of it, and then it's expanded on other services as well. Considering the financial report of 2020, its revenue is 2,776 crores, but right now it is at a loss of 3,768 crores. In my term paper, I would like to analyze at what point of time would Swiggy be profitable or would break even. I won't expand on on what break even is since we've covered it in class. And I will get started with what my analysis is. So first of all, I took the timeline of how Swiggy has grown over the years, and we see that the growth is tremendous. At one point, I've written it up. I've skipped some datas and tables for the sake of PPT and for the sake because I'm on a clock. But on my term paper, I've noted how the growth has expanded over the years, and it has been phenomenal, especially after COVID has gotten eased up. So the timeline shows that the growth is phenomenal, but still it is at a loss. So I take up that something is wrong with the unit economics of Swiggy. By unit economics, I mean that if per delivery it's taking 30 rupees and it is hiring a person as a delivery agent to deliver those orders, something is wrong that it's taking a net loss at each delivery. And for the analysis, we consider that let's take that delivery person's salary to be 10,000 rupees per month, which is not adding any bonuses or perks that he might be getting. So if he is given 10,000 rupees per month, and these 10,000 rupees per month are taken for retention, because if people start leaving, if delivery agents start leaving, then that is a net loss. So taking 10,000 rupees as a template, we find out that it needs 14 deliveries per day to make it break even, to make the unit economics balanced. But the case is not so. In Delhi NCR, from the data we find out that in Delhi NCR, only 6 deliveries a day are made on an average by a delivery agent, which is far less than 14 deliveries which would have been targeted. So that means that we are at a net loss at the unit economics. And what Swiggy came up with was to increase the number of orders so that it could break even. What happened was Swiggy started giving discounts, and for that discount, it started taking a compensation from restaurant as well. This happened in a later stage when Swiggy got established, and we assume for the sake of our analysis that this whole mechanism is balanced. What I'm trying to say is we are assuming that the discount it gives is balanced by all the cut it takes from the restaurant itself. Now we move on to the basis of the break even. Now what we are saying is, first of all, it has to recover its loss in whatever number of years which is taken to be n for the analysis. And also it has to make sure that all these drivers are paid in that interval as well. Because drivers who are not paid are considered a liability in the balance sheet itself, right? So we are assuming that it has to pay all the employees as well as redeem all its net loss that it has so far. We have eliminated some liabilities, and I'll explain why we have done so. And we have assumed that all the interest that the net loss will be pertaining is also balanced by the analysis. So we see the maths, and we see that to balance the net loss of 3,768 crores, Swiggy has to make 35,500, and Swiggy makes 35,500 deliveries per day. Again, this data can be found out in the term paper. I've pasted all the sources there and all the tables there. What we do is we find out that if, assuming that each Swiggy delivery agent handles 4 orders a day, we are thus taking that 9,000 Swiggy agents are there. So now that we found out that there are this much Swiggy agents all across India, and these will be retained because we are giving them the minimum salary. Then we found out that how much cost is needed to basically break even, and this is the cost that is needed. Then we found out that how many deliveries are needed, and then we divided them. And finally, we get this equation. So solving for n, we can get how many years would it take. N is the number of years, and this is the equation we've gotten. And when we solve it through a solver, it basically says that it cannot solve this equation. I tried to solve it, and it was a Lambert function. I had to study what a Lambert function was, and I found out that the answer was coming out to be minus 427.58. So basically, Swiggy cannot break even in the near future if it doesn't change the unit economics of how it works. Some alternatives that I found out through my reading were how could Swiggy break even, and what are the steps that it can take now. So some of them are that it can increase delivery cost. I mean, it can increase the cost that it's taking, but then again, it might work. It might end up in a wrong way because the competitions might not accompany Swiggy in raising the cost, and thus it will lose on the potential customer base it has. What other thing that it can do is reduce the workforce. Reducing the number of drivers might also help it to break even, but then again, reducing the number of drivers also mean that the
You have 1 minute left.
deliveries would be slower, and that would be a problem. Again, another thing that they can do is use the data to come up with other services. And like lately, Swiggy has also come up with Instamart that uses people's habit, and you can also see it in the screenshot, to basically come up with different models and aim the targeted audience better. Another thing that it can do and is doing is coming up with cloud kitchens and restaurant by its own names. That means using the data again to coming up with cloud kitchen. And cloud kitchens are basically ghost kitchen that only cook and have no facilities of dining. That can be a very profitable model for itself. Then again, the last thing that it can do is a la carte delivery service, which they have already started, which is known as Swiggy Jig. So yeah, that's it. And these are all my sources.
Okay, thank you, Harsh. Now we have group 10 consisting of Anirudh, Tony Abhishek, Surendra Kumar Kala, and Shashwat Raj. So please share your screen and present. Hi, is anyone from group there presenting? Will you be presenting right now?
Anirudh, um, hello Anirudh.
Hello,
Uh,
audible?
Yes, you're audible.
Visible?
Yes, your screen is visible.
Our presentation is private equity. We are from Group 10. We are a team of four. First of all, what is private equity? Private equity firms buy stakes in private companies with the hope of making a profit by later selling those stakes for more than was initially invested. Private equity firms have a buy low, grow faster, sell high strategy. It's like the stock market, but instead of stocks in public businesses, private equity firms trade ownership stakes in private business. And simply, private equity firms are simply money managers. They do not operate the company they control or own. Private equity raises funds of money from a variety of sources that will invest in private businesses, relies on a focused team of operating managers to run their portfolio companies, makes money from fees on the assets under management and from the increased value of the business they own. Typical uses of private equity capital accelerate growth and expansion, acquire other companies, buy out shareholders, partners or lenders, acquire assets or fund projects. Who invests in private equity funds? Sophisticated investors, endowments and foundations, pension funds, insurance companies, RIAs and wealth managers, family offices, high net worth individuals. How is private equity different than venture capital and other forms of private business capital? Private equity firms invest in companies that are in the growth stage of their life cycle. Private equity firms generally want to see at least 3 years of profitability before investing. Friends, families, angel investors, and venture capital will invest in startups or in companies in the early stages of their life. These companies are often pre-profit or in their first few years of turning a profit. Later, it happens. Later, initial public offering (IPOs) happen in the company's life cycle. A private equity fund. We focus on this two ways in which investors can gain access to private equities through secondary and primary investment. Investments in the primary market are made directly in newly formed private equity funds. In the secondary market, investors buy existing limited partner private equity interest available on the secondary market from their limited partners. Built-in advantages are owned by. Unlike public markets, a private market investor may have information advantages such as access to management and greater visibility in a potential portfolio company and its operations. The private equity market is also inefficient compared to public markets and thus provide additional opportunities for attractive valuations. On the whole, the private equity investor has the ability to influence a portfolio company for the better, both in terms of operating improvements and positioning the company for growth. On the sell, private equity investors have the luxury of time. They are not managing to quarterly earnings and can choose to exit at the most advantageous time. Returns, cash flow, and liquidity. The Jacob of the private equity investment cycle. Investors fund the commitment in the first 5 years. Invested funds are typically returned in 5 to 6 years. Preferred return paid to investor, profit and gains distributed thereafter. No interim liquidity options. Private equity funds generate higher returns than public markets. Average annual private equity returns typically range from 10 to 15% depending on annual year. For the following are standard terms for private equity funds. 2 to 3% annual management fee charged on either committed or invested capital, 5 to 10% annual preferred return to investors, 20 to 30% carried interest profit, 10-year fund life with 12-month optional extensions, 5-year period to make investments, requirement for diversification. How to manage selection, track record of success, strong deal flow, well-defined strategy and aligned experience, market and operational expertise, reduce risk, continuity of investment partners and decision makers, revolving doors at private equity funds add risk. How do private equity firms source deals? Private equity firms find their deals through investment banks, referral sources, management team sponsors. And at the conclusion, private equity is a rapidly growing asset class with superior returns. Higher long-term returns have attracted well-sophisticated investors. Evaluate your personal portfolio and return objectives. Access your tolerance for risk and desire for return. Select fund and manager that meet your investment objectives. Be thoughtful about your selection of a manager. Thank you.
Okay, next we have Group 12 consisting of Aniket Bhandare, Divya Mishra, Yashwardhan Singh, Aditya Kumar, and Harshvardhan. So please share your screen and present. Hello. Aditya Kumar, I can see you are there. Is your group present?
Ma'am. Yes, ma'am, we are presenting. Just
Okay.
give us. So,
Uh,
Aniket, you can present.
Okay.
I hope the screen is visible.
Yeah, yeah.
Yeah, okay. Sorry, there was a miscommunication. Yeah. So, good afternoon. We now present the case study on SBI card IPO. IPO, to just brush up, IPO stands for Initial Public Offering. It is a process by which a private company can go public by sale of its stocks to general public. So companies raise equity capital with the help of an IPO by issuing new shares. So SBI Cards began with a joint venture between SBI and General Electric Capital in 1998. And then General Electric sold its share to CA Rover Holdings and SBI. And the major players in the credit card sector currently are HDFC, Axis Bank, ICICI, and SBI, with over 70% market share. SBI is the second largest credit card issuer in the country. And as you can see from fiscal year 14 to fiscal year 19, uh, the market share of SBI cards rose from 15% to 18%, which is a good thing, which is a success. This can be attributed to their aggressive marketing and co-branding strategies. The agenda of our discussion is as follows, and from here on, Aniket will continue.
SBI is the second largest credit card issuer in India. It holds 19% market share after HDFC, which holds 25%, and the third bank is the Axis Bank. It has SBI has a base of over 12 million cards in force, wide range of credit cards for diverse customer segments and for changing needs of customers are available. It has well established network in urban and rural area which will help a lot in customer acquisition and through cross brand partnerships. SBI symbolizes the trust as it is a PSU bank, so it becomes much easier for it to expand its business. Next slide. We can see the tremendous growth in the revenues of SBI card over the past 5 years. The revenues has grown more than 300% from 3,000 crores to 9,200 crores. Next slide. The revenue rise is mainly because of the demonetization and the promotion of digital payments all over the India. The uh, we can see that because of these new startups and the fintechs all together, we are getting uh, one more and more steps closer to the our goal of cashless economy. Next. Here we can see the shareholding pattern of SBI cards pre-IPO and post-IPO. Before post-IPO, pre-IPO, we can see the major equity is held by the Carlyle Group and SBI itself. Post-IPO, the shareholding pattern is as follows. The promoters hold 69.4% of the total equity shares, whereas the FI holds 13.1%, DII holds 9.7%, and the public holds 7.9% of the total shares. Thanks. Next. Now, Yashvardhan
Uh,
will continue.
yes. So as we can see, the company has shown strong financial growth over the years. The total income increased from around 3,471 crores in 2017 to 7,286 crore in 2019 to 9,700 crores in 2021. The net profit as well has shown a great increase from 372 crores in 2017 to 862 crores in 2019 to 1323 crores in 2021. But as we can see in this slide, COVID has also left a little impact on growth of the company in the previous years. Next slide. Divya.
So I will present them. So the key business driving factors for SBI cards are demographics. So first of all, India with a median age of about 28 years is one of the youngest countries in the world. Up 60 around 90% of our population is below the age of 60 years. Research has shown that millennials, which is people who are less than 30, age less than 30 years, are more likely to use credit cards and digital payments compared to older population, and this is one of the key factors in the growth of digital payments in India. The second factor is shift towards a digital economy. So post demonetization, there has been a dramatic rise in the penetration of credit card in India, adoption in India, from 1.8% in the fiscal year of 2016 to 3.4% in the fiscal year of 2019. This can be this rise in digital payments has of course helped SBI cards also expand its businesses. The third factor is no cost EMI. So a credit card holder can now purchase his desired product and pay for the product through no interest installments. And this has helped the growing working class in this country that wants to that has an increased capita expenditure to to purchase to expand its payment, and also benefited
Yes.
the income of credit card companies. The next factor is strong parentage. Of course, SBI as a brand is one of the most potent in India. SBI is already the largest market share, holds the largest market share with respect to debit cards in the country. And SBI also holds SBI is uh, SBI has topped the list in terms of digital payments for 3 consecutive months in 2021. SBI commands 25% market share in transaction volume of mobile banking. SBI has also been at the forefront of digital innovation with its flagship digital and lifetime platform like Yono, which has furthered digital lending in a very seamless manner. So overall, SBI is a brand has also been a rising has also been a growing um, company, and that has helped that has also benefited the reputation of SBI cards as a subsidiary of this
Additional it is being given to you.
what happened.
I'm sorry, because of my internet connection, I was disconnected. Let me share the screen.
Okay, so was I audible?
Yes, you were audible.
Yeah. Continue, please.
Share this, yeah. And the lastly, we love to talk about co-branded partners. As we already told, SBI cards is known as the largest co-branded card issuer in the country, which has partnered with brands like Air India, IRCTC, Apollo Hospitals, and Yatra. This automatically increases the demands for its credit cards, as there are benefits available to partnerships, and as the benefits are extended to the customers of these co-branders. And from the figures, it can be seen that these partners have also improved the customer base of SBI cards, contributing for around 30% of its total new customer acquisition in the financial year 2019. Next, I'd like to invite Aditya to present.
So let's talk about a few weaknesses of this IPO. Number one was asset quality. So due to the global financial crisis of 2007, several assets have turned into a non-performing assets. But with the help of government and the policies of SBI, its gross non-performing asset have been slightly brought down and its average around 2.5%. And another factor was dependence. As we have seen throughout the discussion, there is a heavy dependence on its promoter, that is SBI. SBI helps to save the company from external shock, raise fund, and acquire new base too. But after all these factors, this issue was opened at rupees 661, and after a few years, it's successfully trading at 1081 rupees as of now. So this was all about SBI credit card IPO. Thank you.
Okay, thank you. Ma'am,
Yes, Samriddhi.
there is only one group left, but
Okay.
that is group 11.
Okay.
But these people are busy with some quiz and they'll be only be able to join by 4:15.
So just tell them that we are waiting for them.
Okay, ma'am.
In case they can join immediately, that will be better because everyone else is over with their presentations.
Yes,
We
ma'am.
don't have any other groups left, na?
No, ma'am.
So
No,
just
ma'am.
tell them to join immediately.
Okay, ma'am.
Excuse me.
Yes?
Yes, ma'am. It's group 11 here, Sharon and Akshat. So I have joined the meeting, and I think Akshat will be finished with this quiz in 5 minutes. I've just pinged him. So,
So Sharon, you can start. You can start with the presentation.
okay, ma'am. All right. So, what we've done in this in our term paper is we have done a business case of Paytm, and we have considering that they have offered their IPO for subscription on 8th November 2021. We through this presentation we try to figure out the drivers of success for Paytm and its value, and to figure out whether a judgment call can be made based on its drivers of success with respect to subscribing for its IPO. So, so what I've right. So what we've done is I've basically uh, figured out what are the main drivers of success for Paytm, and then Akshat had further added his point of view with respect to the competitive landscape. With regards to uh, what exactly Paytm is. So we know that it's a huge fintech company. It has a huge consumer base of 3.3 crores, 2.1 registered merchants, as well as a huge brand value. Coming to what exactly its business segments are, so they can be divided into three main verticals with respect to payment services, commerce and cloud services, financial services, and it is the only Indian fintech company that has its own layer on each of the payment stack. Coming to its IPO, it has opened for subscription on 8th November with the issue size of rupees 18,300 crores. And its main objectives here was for initiating initiatives to go for new initiatives, acquisitions, partnerships, and to retain its customers and merchants. So the main drivers of success that we could figure out here are the huge growth in smartphones in India for the past 10 years, the rise in mobile payments, which is attributed to the poor banking outreach, and the introduction of UPI. So we have seen that Paytm is dominating the peer-to-merchant payment segment in the UPI sector. Right. Another thing that we've figured out is that there's a huge parallel with respect to growth in mobile smartphones in India as well as the growth of Paytm. So first, if I go through the operating history, what we've seen is that once founded initially in 2010, the founder had uh, basically it was operated as a prepaid mobile platform, but with each upcoming year and with each shift in the market, Paytm has offered a new service almost every year after 2014, whether it was a Paytm wallet, the ticket booking services, or the Paytm Mall, the Paytm Gold, by attributing to the attraction of Indians to gold, Paytm Payments Bank, Paytm Money, and Paytm for Business app for the offline and online merchants. So these are the overall business sectors that Paytm is going into. Uh, Again, divided into three main verticals. Coming to the financial history, we have seen that there is a huge increase in the user transactions since 2017 till the financial year 21. And there's a huge increase in users as well as the gross merchandising value. But what we are seeing is that they are not able to convert these user transactions into revenues. We've say there's seeing a constant negative operating income, and what this basically means also a very significant decrease in the take up rate as compared to 4 years ago. And take up rate is basically the percentage of the revenue based on the gross merchandising value. So basically, Paytm is in its growth state, and it is burning cash to acquire a large consumer base and merchant base. We are seeing that basically this company is more focusing on capturing a huge market share and not really converting their consumers and merchants to get the revenues. Coming to the funding and ownership, so unlike other initial startups, after getting the initial VC, they have basically gotten a lot of investment from the big Chinese companies like Alibaba Ant Group and SoftBank. So although the company's origins in India, it is primarily a Chinese-owned company, and the founders' holdings has dwindled down to 15% of the company. So Akshat, if you could take over here.
Actually, the screen is not visible to me, Sharon.
Okay. Um, is it visible now?
Yeah. So now we'll talk about how who are the competitors for Paytm and what does the entire landscape, the market landscape looks like in India. So yeah, broadly we'll be talking about two things here. How does the market looks like, who are the competitors and what are the market segments these are playing in, and the second is who could be major threats for Paytm going ahead. So Sharon. Yeah. So here, what we need to understand is the first and foremost point here is that more than 75% of the revenue for Paytm is driven by the payments segment only. So I'm broadly talking about that segment here, only. So if we look at the broad distribution, so the UPI transactions that happen in India, so 55% of these transactions are P2P. P2P is basically peer-to-peer, like between you and I basically. And in this segment, the P2P segment, Paytm is, I mean, rather behind with a meager 11% of market share only, which is if you look at the
left.
Okay, sure, ma'am. So if you look at Google Pay and Phone Pay here, so they are much far ahead. But in the P2M segment, which makes 45% of the transactions by value in the market, Paytm has a 55% market share. And as per CEO of Paytm, that is Mr. Vijay Shekhar Sharma, he is focused on this segment only, and he's been trying to build products in this segment only. And one of the examples for this is Soundbox. Yeah. Sharon. So yeah, what Paytm is trying to do here is they've built this wide array of products in more than a decade of their of history. These are UPI and mobile wallets, and then they have branded cards as well. They are into investing and wealth management and all these stuff. And in each of these segments, they have quite a lot of competitors, and these are very close competitors, or rather, I mean, they hold a market share that Paytm does not even have a small percentage of. And
Another 1 minute is being given to you.
Sure. Thank you, ma'am. So yeah. So if you look again, if I talk about the UPI segment only, so as we saw that PhonePe and Google Pay, they are holding a lot of market share here, and and one of the major threats moving ahead could be WhatsApp as well, because looking at the numbers, WhatsApp has 400 million active users monthly active users in India, and moving ahead, it would be very easy for us, especially in the P2P segments where Paytm already suffers. So I think the market share could further decline there. And since WhatsApp is also including WhatsApp shops, etc., kind of things, so in the P2M segment as well, they might face a very fierce competition. And yeah, moving to the next slide. Yeah, so finally, for the future, what we look for the Paytm and in general this market in India is that it is possible that they see a very stellar growth, since the smartphone and internet penetration in India is definitely going to grow, which will definitely grow the GMV for them. It just depends how much of it will they be able to capture in terms of revenue. That is one of the major problems that we've pointed out in our term paper as well. That is the take rate. Take rate is defined as the revenue upon GMV, the ratio of revenue and GMV basically. That is very low for Paytm. That is less than 1%. It's 0.76%. So that is a very grim situation for Paytm here. And secondly, the Paytm has been allocating their resources, their expenses mostly to drive marketing and employee costs to acquire more customers and more merchants on their on their platform basically. And they've also been buying different companies and technology to drive this growth. So the shift that we are looking at here is probably how they turn their business into a profitable business, because as of now it's growing, it's growing, but only in terms of the GMV value or the new customers that they are acquiring each year. So but how they turn profit, that is something that we would like to look at in the future. So finally, yeah, so finally concluding, as I said, the market size is only going to grow as economy grows and it becomes more digital. Second is which is very which can be very which can make Paytm's future a very difficult future could be that is it is trying to enter and capture a lot of different market segments and trying to be a super app. But in this journey, it could either be a huge success or a huge failure as well, because each other competitors are working in their own niche and they are working and they are performing pretty well. And the third thing that I mentioned was again that they are spending most of their money in acquiring customers and technology. And in the IPO document of Paytm, they also mentioned that this is going to be the strategy for the near future as well. And finally, new competition and competitors are still adding in the market. And one of these things are BNPL. BNPL is basically buy now, pay later. So these services are also gaining traction. And I mean, we could also see Paytm entering into it. And I think they've already entered into it. I mean, they're doing their research and trying to enter the market here as well. And finally, the take rates, which are too low, as I mentioned, 0.76%, which is, I mean, for old players such as Mastercard and Visa, these are as high as 25%. And even for PayPal and Square, it is in the range 2 to 5%. And if you look at Paytm, which is only 0.76%, we really don't know how Paytm is going to fare as a sustainable business after the existing investors pull out their money. So yeah, that's it. Thank you.
Thank you.
Okay, so Samriddhi, we are over with all the presentations now?
Yes, ma'am.
Okay, so all of you, I think this is the end of our meeting. Now we'll meet on 20th in the morning, online or offline as the case may be. So if there are any doubts, any questions with regards to all of that, please let me know. Okay, so Samriddhi, I think this is it then. I think we've already informed them of everything. Nothing more left to be informed, right?
Yes, ma'am.
ठीक है Samriddhi. So I think everyone, thank you so much. Thanks Samriddhi, and you can give me a call, Samriddhi, after the class.
Okay, ma'am. Thank you, ma'am.
Fine. Thank you. Bye bye.